Interval funds, despite coming back into the news and becoming a little bit more popular the past couple of years, they've really been around over 20 years. Date back to around the 1992, 1993 area, where SEC really wanted to take the really two investment categories, which are open-end funds and closed-end funds, and try to take the best characteristics of each. So when you think of an interval fund, like an open-end fund, doesn't trade on exchange, it takes in assets, so it can expand. And like a closed-end fund, right, it allows you to invest in less liquid securities, okay? An open-end fund maxes out at around 15%. So a closed-end fund can go 100% technically in illiquid securities. And what we find is that these interval funds, okay, are most appropriate for less liquid strategies. So it's come into the place that more hedge-like, more institutional-like categories, strategies, I should say, are better suited for the interval fund structure. And the liquidity is typically quarterly. All right, and what's good about that is that it allows you to be in these less liquid areas that you not have to worry about the daily liquidity. All right, they don't trade on exchange. You will see your NAV. All right, they can, like a traditional closed-end fund, they are categorized as closed-end funds. They can use senior securities, so they can leverage, unlike you can the same way on an open-end side. A traditional closed-end fund can invest basically in anything illiquid, as long as it's not too much commodity related. But what you'll never see, very few closed-end funds go beyond like the 15–20% area of limit in illiquids. Interval funds, you see many of them in private investments. There are private real estate funds, there are private credit funds. So you'll have maybe 60, 65, sometimes even more in private securities. And they'll maintain access to some public securities, very liquid, highly liquid securities for these typical redemptions, which are typically quarterly. In the past 10 years or so, there's been a big play on like liquid alts. So alternative investments, there was a panel here at the CIFA conference talking about alternative investing. And I think interval funds fit that category, okay? It gives you access, and really it's for an investor, for that portion of their portfolio that they're going to dedicate, that slice, to alternative investments, okay? These alternative investments will help diversify your portfolio, act as a non-correlating asset. So I think that's where it's most appropriate. And the benefit of it is these types of securities, these types of investments, I should say, they've been around for years, but on the private side. And on the private side, you really, it's a higher threshold to purchase and much less liquidity. There's usually lockup periods, 7, 10 years, maybe even longer. So with an interval fund, you're actually getting, despite quarterly redemptions, you're actually getting better liquidity. I think it's new to them. I think they should learn it. I think the strategies that are out there are very interesting, and they were never really available to the retail investor. And now through the interval fund structure, I think it's great access for them.